$135 per share. $1.75 trillion in implied value. $75 billion. The largest amount any company has ever sought to raise in a single public offering in the history of financial markets. Those are the numbers SpaceX put on paper. Numbers that, by any historical measure, place this moment in a very specific category. Not the category of great companies. Not even the category of great technologies. The category of moments when a market decides, collectively, formally, irrevocably, that it believes in a version of the future, enough to price it at $1.75 trillion. That has happened before. Not often. But enough times that history has something to say about it. And history always leaves a trail. There is a specific moment in the life cycle of capital markets that historians have documented across centuries. It is the moment when a single asset, a company, a commodity, a technology, captures the collective imagination so completely that its price becomes less about what it earns and more about what people believe it will become. Economists call it narrative-driven valuation. The pattern is older than the stock market itself. In 1637, Dutch tulip contracts traded at prices equivalent to 10 times a skilled craftsman's annual salary. Not because tulips generated income, because the story around them had become larger than the flower. The mechanism is always the same. A real innovation appears. The innovation is genuine. It changes something. And then the market, responding to that genuine change, begins pricing not the present reality, but an imagined future. The gap between what a company earns today and what the market says it is worth becomes a measure of collective belief. SpaceX is a real innovation. Reusable rockets are a genuine technological achievement. Starlink's 9 million users represent real revenue. None of that is in question. The question the pattern asks is different. At what point does the price of belief exceed the evidence that supports it? In December 2019, Saudi Aramco completed what was then the largest IPO in history, raising $25.6 billion and achieving a valuation of $1.7 trillion. The offering was described as the definitive proof that fossil fuel infrastructure remained the backbone of global capital. Sovereign wealth funds lined up. The narrative was airtight. Aramco controlled more proven oil reserves than any entity on Earth. Within 18 months, Aramco's market value had fallen by more than 30%. Not because the oil stopped flowing, because the narrative around energy had shifted. And the valuation had been built on the narrative, not on the structural fundamentals beneath it. On the morning of May 18, 2012, Facebook opened for trading on the NASDAQ. Mark Zuckerberg rang the opening bell from the company's headquarters in Menlo Park, remotely via video link, surrounded by engineers in hoodies. The symbolism was deliberate. This was not Wall Street's moment. It was Silicon Valley's. By the close of that first day, the stock had barely held its IPO price. 3 months later, it had lost more than half its value. The engineers in hoodies were still building. The product was still growing. But the market had paid $104 billion for a mobile advertising business that did not yet exist at scale, and was now waiting for reality to catch up to the price. It took 2 years. AOL and Time Warner merged in January 2000 in a deal valued at $350 billion, the largest corporate transaction in history at that moment. The combined entity destroyed more than $200 billion in shareholder value over the following 2 years, The merger was built on the premise that the internet would transform media economics within years. The premise was correct. The timing and the price were not. 3 different companies, 3 different industries, 3 different decades. The same structural pattern. A genuine innovation, a valuation built on narrative, and a gap between price and evidence that the market eventually closed. On its own terms, on its own timeline. When a market assigns a valuation of $1.75 trillion to any company, it is not calculating present value. It is making a collective bet on a specific version of the future. That bet is not irrational. It is simply operating on a different set of inputs than traditional financial analysis. The mechanism works like this. A company demonstrates genuine capability in a field with enormous addressable markets. Early investors, seeing the potential, assign a premium to the growth story. That premium attracts attention. The attention generates media coverage. The coverage creates broader awareness. And broader awareness brings in capital that is no longer evaluating the company on its fundamentals. It is evaluating the story. In the spring of 1999, a 27-year-old analyst at a major investment bank sat in a conference room in Midtown Manhattan reviewing the prospectus of a company called Pets.com. The company had been operating for less than a year. It had no path to profitability visible in the numbers. The analyst recommended the offering anyway, because the story around internet commerce was so powerful that questioning the valuation felt, in that room, on that morning, like questioning gravity. Pets.com went public in February 2000. It was delisted 9 months later. The analyst was not incompetent. The room was not corrupt. The mechanism that produced that decision is the same mechanism that produces every narrative-driven valuation in every era, including this one. When the story is large enough, the numbers become secondary. Not because anyone decides to ignore them, but because the collective belief in the story makes the numbers feel like a temporary condition rather than a structural constraint. The question that historical analysis consistently returns to is not whether the story is true. It is whether the price paid for the story leaves room for the story to be true enough. Saudi Aramco's story was true. Oil remained critical infrastructure. But the price paid in 2019 left no margin for the energy transition that was already underway. Facebook's story was true. Social media would define digital advertising. But the 2012 price left no margin for the 2 years it would take to build mobile revenue. Spacex reported revenue of $18.6 billion in 2025. That is a real number. It represents genuine commercial activity. Rocket launches, satellite internet subscriptions, government contracts. By any conventional measure, it is the financial profile of a significant and growing company. The same financial statements show a net loss of $4.9 billion in 2025. In the first quarter of 2026 alone, the company reported revenue of $4.7 billion, alongside a net loss of $4.3 billion. Total assets stand at $102 billion. Total debt stands at $60.5 billion. These numbers are not evidence of a failing company. They are evidence of a company investing aggressively in infrastructure that does not yet generate returns commensurate with its cost. Starship development, satellite constellation expansion, launch facility construction. The spending is real. The assets being built are real. And the future revenue they might generate is genuinely uncertain. What is also documented? On June 4th, 2026, Standard & Poor's Global announced it would maintain its S&P 500 eligibility rules unchanged. That decision means Spacex, as currently structured, cannot join the world's most followed equity index in the near term. For institutional funds that track the S&P 500, this removes one of the most powerful automatic demand mechanisms a newly public company can access. It is a quiet detail in a loud story. But historically, quiet details have a way of becoming louder over time. History does not repeat with precision. The specific details change. The industries change. The personalities change. What the historical record consistently shows is that the underlying structure, genuine innovation, narrative premium, gap between price and evidence, tends to resolve in ways that the original valuation did not anticipate. This is not a prediction about SpaceX. It is an observation about the conditions under which the valuation was set. A company that loses $4.3 billion in a single quarter, while being valued at $1.75 trillion, is operating in a specific zone of market belief. That zone has existed before. The companies that navigated it successfully did so by closing the gap between narrative and numbers faster than the market expected. The ones that struggled did so because the gap proved wider than the story had suggested. What makes SpaceX structurally different from Aramco, from Facebook, from AOL is also worth noting. SpaceX operates in a market with no historical precedent at this scale. Commercial space infrastructure did not exist as an investable category a decade ago. Starlink represents a genuinely new revenue model. The Starship program, if it achieves its stated objectives, would alter the economics of access to orbit in ways that current financial models cannot fully capture. The pattern does not tell us whether SpaceX will succeed. It tells us that the price being paid for that success assumes a very specific version of the future, and that markets, historically, have tended to reassess that assumption on timelines that surprise both optimists and skeptics. Every major IPO in the historical record left something behind that was only visible in retrospect. Aramco left the clearest signal, yet recorded about the market's willingness to price fossil fuel infrastructure at peak narrative. Facebook's difficult first year left a blueprint for how social platforms eventually monetize mobile behavior. AOL left the most expensive lesson in the history of media consolidation. SpaceX's offering leaves something too. At $1.75 trillion, it establishes a price for the belief that private capital can build and operate the infrastructure of space at civilizational scale. That belief may prove to be exactly right. The history of technology suggests that civilizational infrastructure eventually justifies civilizational scale valuations. The history of capital markets suggests something else, that the journey between the price paid and the value delivered is rarely as straight as the prospectus implies. The trail is always there. The question is whether you are reading it before the market does, or after. If you want to understand how capital really moves, not through headlines, but through the structural patterns that repeat across decades, the resources in the description are where serious students of financial history begin. Ray Dalio's work on debt cycles and Edward Chancellor's history of financial speculation are the two books this channel returns to consistently. And if you are thinking about how real assets fit into this picture, the link below is worth your time. SpaceX IPO is not the end of a story. It is the beginning of a trail. The trail doesn't end here. If you want to be there when the next trail is uncovered, the notification bell is the only way we can guarantee you'll know.